Hi, everybody. My name is Rob Noonan. I'm a co-founder of Rialto Markets and your host for today's webinar, Secrets of Success, Private Securities in 2022, and a look ahead to 2023. Alongside me, I am delighted to have my fellow co-founders of Rialto Markets, our CEO, Sherry Noonan, and COO, Joel Steinmetz. Also joining us is our CTO and Head of Market Structure, Lee Sava, all of whom have a wealth of experience in Wall Street, as well as private securities. But before we hear from them, let me set the scene for what we're going to discuss and share today. It's customary with year-end reviews and forecasts to look at the highs and the lows of the market. For instance, Statista forecasts that global spending on equity crowdfunding alone will top $17.8 billion by the end of 2023, up more than 15% on 2022's 15.13 billion, and a staggering 189% since 2022. The US growth is forecast even faster at 17% in 2023. For this to happen, we need continued growth in retail and accredited investors' confidence, with more legislation and compliance oversight expected. I'm sure the panel will give us more insight and share other findings too, such as an independent private securities survey published in the media this week, which went out to 250,000 people, comprising private company issuers, investors, and industry professionals. We will also touch on the cryptocurrency markets, NFTs, and other digital securities, and what might happen next on oversight and regulation. So now it's the panel's turn, and I'll ask Joel Steinmetz first. He's up first to tell us about Rialto Markets year and the outlook for 2023 for issuers and investors alike. Joel?
Thanks, Rob. Pleasure to be here. Thank you, everyone, for joining. Just really want to get started before we discuss Rialto. Let's get an understanding of the marketplace in general. And the first question I think to be asked is, why private securities? Why private, not public? And of course, the answer that has been known for a while is companies are staying private 4 times longer than they had been about 20 years ago. So a lot of the wealth that is generated within the private securities market. So take for an example, 2 stocks that everyone's well aware of that went public and came out into the marketplace a little more than 20 years ago. Microsoft had a little over 90% of its value created in the public markets. Amazon had also a little over 90% of the value it created in the public markets. So if you wanted to participate in the value of those stocks, you were best off going into the public markets. If you got in the private side, you got a little extra, but you still were able to get a ton within the public markets. Fast forward to the last 10 years, and let's take 2 other ones that have come out in the last 10 years. One is Twitter. Twitter, 98% of its value was created in the private markets. Airbnb, 98% of its value was created in the private markets. These are significant amounts that are flipped from value creation in the public markets to value creation in the private markets. So if you're looking to find ways as an investor to be able to gain that value from your investment, you need to be in the private markets. Now, that's the difference, if you will, between the public markets and the private markets. Now let's break that down a little bit further and go into the methods of investing in the private securities markets. Private markets have been around for a long, long time, and people have invested them for a long, long time. But it really was only in the last decade or so that individual investors were given the opportunity to participate in those private investments. Due to various rules like Reg A and Reg CF, those crowdfunding capabilities allowed individual investors to get involved where heretofore they were not able to get involved. And that means that in a market where most of the value seems to be created or maintained within the private sector, it's essential for investors to be able to have access to that private sector. So we move into the Reg A and the Reg CF world. Now, if you look at the 2022, the Reg CF and the Reg A world took a little bit of a divergent path from the other. Reg A had been on a great rise in 2020 and 2021. And then in 2022, as we can see, if you go to the slide right before this of the Reg A market was really, the total deals offered was down 2%. And its value that was looking to be sought, the money looking to be raised, was down 17%. That really mainly took place because the fourth quarter was down quite significantly. Markets were tough, economic conditions were tough, and therefore you saw a lowering in the amount of companies that were looking to raise capital through Reg A, and perhaps more importantly or more telling, they were looking for less money. They were looking to raise a little less capital, perhaps a little dose of realism that said you're not going to be able to raise the amounts that you thought you'd be able to raise within the Reg A markets. And so you saw pretty much a flat market in the number of companies looking to raise money through Reg A, and a downtick in the amount of money that was sought. If we now go to the Reg CF world, the Reg CF in essence had the mirror image. The amount of deals was up 2%, and the amount of capital being sought was up 19%. Now, the significance of the amount of capital being raised is shown in that last slide, chart on the right. In 2020, the average amount a company was looking to raise through Reg CF was about $500,000. In 2021, it just broke $1 million. In 2022, it's closer to $1.5 million. Basically, companies are looking to raise more capital through Reg CF. Reg CF still has a nice uptick in what issuers are looking to do, how investors are looking to get involved. And so we're seeing that within the private securities market, an essential place for investors to be, there is this rise of ability for individual investors to be able to get involved through either Reg CF or Reg A. Now, we're just at the beginning. We will increase that as regulation, which has opened up the doors tremendously, increases within the secondary markets and starts to allow for secondary trading of Reg A securities and perhaps Reg CF and Reg D securities when they've passed their seasoning period. That will enable the various investors who couldn't get involved to still get involved in a secondary way. It will allow the original investors some monetization capability. And that is just beginning. We're really at the infant stage of getting involved in that. As far as Rialto is concerned, Rialto has seen a great uptick. We have contracted 46 different issuers to raise capital through Reg A, Reg CF, or Reg D in 2022. We have 17 deals that are currently live, trying to raise approximately $1 billion. So we are seeing that we're able to take advantage of what Reg A and Reg CF have done in the private securities market by enabling access. That's really been the key. We have the most robust markets in the world, but enabling access to those robust markets has been difficult. Now, in the last number of years, and with the technology that's available and the regulatory oversight that exists, and the companies like Rialto who operate within that regulatory regime are now providing areas and methods for individual investors to participate in the great value creation that's taking place in private securities markets. You know what? Let me touch on this. I'm sorry, Rob, you're still on mute. I'm going to take advantage of that. If you look at the public markets, the public markets really have really, well, they've been hit. The markets and the economy in general has been taking a hit, but Ernst & Young came out with a study that the IPO market amount of deals was down 74% in 2022 over 2021. And the amount of proceeds raised was down 94% through the first 9 months of 2022. So again, when you're looking at the contrast between the private markets and the public markets, we can see not only the value creation that's taking place within the private markets, but also the upside potential of the private securities markets and the struggle that the public markets are having within, whether it's this economy or just because there are so many more access points, so much more support for private securities. You'll hear from the other members of the panel. Shari, our CEO, says this all the time. The private securities markets existed, except they existed without the necessary infrastructure that public securities markets always had. We are now bringing that infrastructure that allows for efficient operational systems, workflows, access democratically that get to a wider audience. All of that has been available to the public securities markets is now becoming available in private securities. And that will further exacerbate the gap between the way the private markets are going and where the public markets are going. Thanks, Rob.
No problem. Thank you for letting me know I was on mute. What I was trying to say was, the value of the companies before and after the IPO. It might be time for people to add alternatives and to break that traditional 60-40 split that we're all so used to. I'd like to now bring in Lee Saba, Rialto Markets CTO and head of market structure. And importantly, he is also co-chair of the independent and globally recognized fixed trading community. He's the perfect person to update us on and review the institutional market and how it's shaping up for 2023. Lee?
Hey, thanks, Rob. Appreciate it. And thanks for everybody joining our webinar today. As Joel mentioned, and some of the statistics that we provided, we're still in the early to mid innings of the investor understanding of this rapidly evolving asset class. I think as people learn more about the Jobs Act securities like Reg A, Reg CF, some Reg D constructs, in that they can not only invest in these companies but can also trade in these companies. It's a remarkable story that just most investors in the U.S. don't understand well enough yet, and it's our mission to really educate the investor community out there about what we're capable of doing. I think it shouldn't be lost that the ability for institutional and retail to participate in these capital raises and the ability to access trading venues like ATSs is it's an unbelievable game changer for investors. It's really something to behold, and obviously we have a front row seat on all of this. Again, just emphasizing, just getting the word out in 23 about Jobs Act securities and secondary trading capability is one of our main goals. And this will continue to change as evidenced, by our own statistics, that we've been presenting. In 23, this is the year, right? That I think, these markets will truly be understood, and investors will understand where they can participate and how they can interact with them. The exciting opportunities that exist from every industry on the planet, you can participate in the private space now. And again, some of those growth statistics that Joel had mentioned about, Twitter, for example, I mean, most of that value was raised in the private arena. And now, retail and institutional have the same access. So we're quite excited about that. So, one thing I wanted to pivot to a little bit was, some of the things that we've seen over the last, couple of years is, what successful raises have in common. And, I've cherry picked a few. There are a few other things, but these are the main ones, and I'll go through them now. Issuers with the following, it definitely matters when raising capital. If you have a strong clientele base and they understand your business model and are excited about your company, that's always a good sign. Targeted marketing is also a key element to meeting your capital raise goals. We've seen that over and over and over again. Again, targeting those followers that you already have. Leveraging the internet, is obviously needs to be super well understood. Making sure your presence out there, using Google statistics and all the other things that are available to us now are huge. Accessing LinkedIn and publications in the various fields that your company is in. Understanding again your followers is just part of that. Knowing your target audience and what drives them. I put out a little piece, or actually I don't know if it's been published yet, but just around a story of an acquaintance I ran into, just in a completely different state, who had already invested in one of the companies that we were raising capital in, and it was quite fascinating because completely retail investor, had no idea, never met this person before, and they were very well aware of the issuer. They were very excited about being able to participate in this, and since then he's been very happy with what's gone on there. The other thing that I really want to emphasize is that regulation is your friend. These aren't crypto markets. These aren't anything like that. All the hard work and costly upfront work to be regulatory compliant makes investors comfortable. When you see the aftermath of, and again, I'm not trying to relate what we're doing here with pure crypto, but those are unregulated marketplaces, and those are, we're seeing the effects of those on retail, and this is a whole different story. So I just kind of want to dispel some of the myths of what's going out there, because there's sometimes some overlap with tokenization and what that means, and you're dealing with pure crypto. That's not what we're involved with. We're into regulated assets only. And just a couple more things. Off ramps matter just as much as on ramps. When an investor uses their cash to purchase shares, they should also have the ability to buy more after the primary or exit their position at some point. Which brings us to our ATSs, right? Obviously Rialto has an alternative trading system that can match buyers and sellers of private securities. And lastly, choose your capital raise partners wisely. I use this joke internally all the time. No offense to your uncle, the real estate attorney, or your aunt, the real estate attorney, but if you're going to get into a capital raise under a Jobs Act security or other, get a seasoned securities law attorney. That's a big deal. And choose a broker that's well versed in private securities and in this market's ecosystem. There are some nuances to this that are not like traditional marketplaces.
I'm just going to pop in on one of the things that Lee said, because I think it's important. Lee described a whole bunch of things that should be considered. If you notice, he didn't specifically mention any industry. And that's because the industry is less important as the description that Lee just gave. Those components become so much more important for what you're trying to do in the capital raise than what the industry is. And if the components are filled, it can be anything. It could be ESG, it can be real estate, it can be medical technology, it could be just about anything you can think of. As long as those factors really start to play, that's really what is the essential nature of capital raise. Yeah, industry agnostic for sure, Joel. And that's very true from what we've seen. It really doesn't matter by industry.
Yeah, the attorneys are so important, and I say to people all the time, if you don't have the right attorney, days turn into weeks, and weeks turn into months very quickly. Staying with institutional, Sherry, I know you want to add something on our partnerships, including Rubicon Carbon and similar arrangements, to the extent that you can talk to them, that are linked to the ATS and or the secondary market, or even the broker-dealer side of our business.
No, thank you so much, Rob. And I know we spend a lot of time talking about our equity crowdfunding capabilities in Reg CF and Reg A, but I think it's also really important to just talk about private markets in general and if you zoom back, what we're really trying to do is we're bringing infrastructure to private markets overall. And this is really a use case of that, of bringing that to the forefront. So we're really thrilled to be working with the team at Rubicon Carbon Services. What they do is they're created to scale market-based products and solutions to really enable net zero goals. So Rubicon Carbon aims to cut through the complexities of the voluntary carbon market, providing an accessible solution to scale those markets. They're backed by TPG, and their launch clients are corporations. So Fortune 100 companies such as JetBlue, Dow, and GE. So we are working with them really an institutional grade client facing other institutions in a Regulation D offering. We are really providing the primary issuance and secondary trading infrastructure through our Rialto Market solutions. And we worked with our team to create bespoke workflows that really accommodated not just the specific needs required for this product set, but also the needs of their corporate clients. And we're really seeing other use cases like this in the institutional space. Institutions are really looking to future-proof their business via our broker-dealer and digital securities mandate to launch, whether it's new products, to utilize different sets of technology, to do one of really two things: either expand the breadth of who they're reaching, or to create completely new investment categories. And we find both of those cases really interesting. And one of the reasons that we entered the private market spaces. So to kind of drill into that, one of the most interesting examples that we've been discussing lately has been institutions that have invested, for example, in music catalogs or diversified into some of the alts and are really looking to hedge that risk for a portion by taking a portion of that and bringing fan communities or other communities in to invest. We also see this as it relates to brands that are looking to engage their communities by offering their fan base the ability to invest in that brand and receive a certain experience or perks or become more closely aligned with that brand. And we really believe that this type of monetization is only going to continue now that the technology to really associate the provenance at scale, it's really readily available, and we're excited to see where this goes and how it evolves in 2023 and beyond. But in the near term, things that we see that have already happened and continue to be happening in the institutional space is an increased interest in digitizing funds. I know Lee touched on this, which allows for increased secondary activity and the ability to facilitate that market with a lot less friction.
Thanks, Sherry. It really does go to show how the secondary trading and alternative trading platform offers so many opportunities for issuers, fund managers, investment advisors, and investors. The music one is one of my favorites. There are a lot of questions that are coming into the chat. Please keep them coming. We will come to them at the Q&A session near the end of the program instead of asking them while we go. Sherry, I'm going to stay with you. I know you've paid special attention to the independent survey of the private securities market out this week, conducted by the World Digital Foundation in association with Crowdfunder Insider. Can you go over some of your findings from that, please?
Absolutely. So bear with me. There's going to be a lot of stats, and I believe we will send this out after this webinar, but it's a really important piece of research into private securities, and it was sent over the last few weeks, I believe, to over 250,000 people from a cross-section of investors, private companies, and financial industry professionals. So I think it covers a really wide group of people, as well as quite a deep sample set. So 86% of respondents said they were confident or extremely confident about the private security sector in the coming year. So that's quite bullish. 65% of all private companies that were interviewed aim to raise capital in 2023, and of those, 80% are aiming to raise capital would consider equity crowdfunding above venture capital, really showing that change and shift towards an adoption in crowdfunding. So this major survey shows that many young private companies are really looking for alternative ways to finance their innovations and attract a new breed of investor, build a fan base, and really build their communities by using equity crowdfunding. So, these ambitious private companies are really interested to build investor communities, to advocate and support the innovations, and then create that virtuous cycle to also have those communities be able to profit in the success, or join in the success of that journey. So we can go to the next slide, slide 8. So it's important to note that building a community, and this is really what I was saying before, it's not really about a financing tool, just about a financing tool. 78% of private company issuers and industry partners said that an engaged community brings additional commercial value to their businesses. So you have people that are building, or companies that are building communities that then are, those communities are utilizing the products and services of the company perhaps, and also then investing in that company. So it's really important to know that it's a community building viewpoint that's not just for the crowdfunding alone. What was really interesting is 27% of the issuers that were surveyed had communities of investors and advocates more than 500,000 strong, which is quite a large community. But over 66% claim to have over 20,000 or more engaged people. 25% of private company issuers wanted to raise up to $5 million. So this was sort of evenly divided. 25% of private company issuers wanted to raise up to $5 million in the next 12 months, but almost as many will aim up from $5 to $10 million, and 22% were looking to raise $75 million or more in the next 12 months. Steve, if you want to go to the next slide. And while 75% of private company issuers said they had used a combination of seed capital, angel investors, and other crowdfunding to raise capital, only 40% had used venture capitalists or other institutional partners. So this is not the right slide. I apologize. I think this was our last, I think we skipped that slide, so I'll just continue. 84% of private companies seek new ways to monetize their assets for investors and employees, and 98% of respondents thought secondary trading was vital to the future of private securities. And then I think we want to move to secondary markets. They felt that they were most applicable for private equity and single issuers, real estate and cryptocurrencies, NFTs, and other really fractional digital securities. And we're seeing the same. We're seeing the same type of interest in those specific areas and sectors. And the top 3 industry sectors for private securities investment were technology and media at 93%, real estate and construction at 74%, and healthcare at 61%. And I think I deluged.
It's important to note, just I'll pop in for a second. It's important to note, Sherry's been talking about building a community. And one of the things that we emphasize to issuers is the play of investor and customer. And when you're doing this properly and effectively, it's very possible that your investor becomes your customer and your customer becomes your investor. And now you've really doubled down, if you will, on the advantages of creating this kind of investment vehicle, because you now have fans that are actual customers going out and talking about what they do, not only what they invested in, but what the company does and how it can benefit. And we speak often also about voting with your feet or voting with your heart. Very often we see people getting involved in things they care about. ESG has become a very big issue because people care about it. A lot of times with some of the medical technology, people care about it because the healthcare, people care about it. They have someone they know, someone they care about who is involved, who can use the solution, etc. All of those things become very important to investors, to individual investors, to be able to say, I want to participate. That same idea holds true in a very different way, but still personal. And that's things you might just like. And it could be the movie industry or music that you just happen to like that. And
Right.
therefore you want to get involved because it's a hobby of yours, for example. Those things very often help build community. And again, when it's building community, you're building both an investor community and a customer community, potentially simultaneously.
And that's really where we see the most success with issuers that are on this journey is they're taking that and they're building a community but they're taking people behind the scenes, right? Taking people behind the scenes to see how things are built and the rollout and really taking people on the journey.
Yeah. We're throwing a lot of stats at everybody. Again, we're gonna be able to send this out to everybody. I know it's overwhelming. I even lost my space. But Joel, in your short time on Wall Street, how are some of these changes impacting the public markets?
Well, it's thank you for considering me young and saying a short time on Wall Street. I've been on Wall Street for quite a bit. And what I find particularly interesting, if you look at the market, and I've been in it for 30 years, if you look at the market, just to be able to figure out the new things that really are market changing. And over 30 years, I don't know if there are that many that you can say really just impacted the market tremendously. ETFs is a real good example. That really changed the way that the world operated in the investment community. What's happening in private securities now is something that is really affecting a change. We often speak about the nexus of private securities and digital securities. Digital securities, as Lee pointed out, should not be confused with crypto. These are digital regulated securities, right? They're just in digital form, blockchain form, for example. And there is a nexus between private securities and digital securities. The question is this going to be something that really helps the industry leapfrog into a new investment era that democratizes all of those investments? So we're seeing it, we see it with Rubicon, we're seeing it with investment vehicles for funds. Well, imagine if you're able to invest in funds in a very different way than you were able to do so in the past. Imagine if you have access to private securities that you were never able to have access to before. How many times did you say, I wish I could have gotten, I knew that was a great idea. Electric vehicles, I knew that was going to be the next thing to come, right? I wish I could have gotten involved. Now you can. And that really changes the outlook of the entire capital markets, both from an issuer's perspective in the reach that the issuer has to capital, and from the investor's perspective in the breadth and depth of the investment opportunities that are now available to him or her. Those things are potentially monumental changes that we're just at the earliest stages. We're really at the infant stage of this kind of growth. Will it be able to take off in certain ways? Well, we'll probably touch on some of the regulatory needs, but it does need that infrastructure that allows for a very smooth experience on the investor side, operational workflow that's very smooth and clear, and as we've been saying, not only a primary market to invest, but a secondary market that operates as an off-ramp where investors can monetize their investments.
Well, and if I can just pop in, so going back to the numbers, so supporting this, 92% of the investors that responded did say they would consider private companies. So I think this isn't lost on the investing community. And that's compared with 78% looking, considering publicly traded companies. So I think investors are looking and saying, if I'm looking for my investment portfolio, I really am going to consider the private market more than I maybe would have 10 years ago, 15 years ago. Now it's about extending the breadth of that investor base. And 47% of the respondents which is a really interesting stat. 47% of the respondents had previously invested in cryptocurrency or other digital assets such as NFTs.
Thank you. Sherry, we know there's a great deal
Yep.
of focus around private securities. What are the question marks being raised?
Yeah. So the question marks really, this market has not had a lot of infrastructure around it. The private markets haven't had a lot of infrastructure around it. And so if you want to go to the next slide. Yeah, thanks. So really the top challenges that investors had via the survey were accessing quality investments in private securities and really, understanding what is quality. So kind of, being able to sift through all of those investment deals. And the second, which is interesting, is tracking and monitoring the progress on those investments, because again, private markets, there isn't the same infrastructure that's available in the public space. And then the third comes back to how to be able to monetize those investments. And that is, as companies are staying private longer, there isn't that monetization mechanism without a secondary market facility, such as an alternative trading system. Mm-hmm. Now, over on the other side of the slide, this stat talks about the private companies. They would over 80% of them are looking to raise capital, would consider equity crowdfunding, compared with 55% for venture capital in the future when raising capital. I think I mentioned that previously in the slide, so I just wanted to tie those stats back for those that are tracking. So moving ahead, investors said that 34% of their investment portfolio would be focused on private securities, which seems like quite a nice chunk of their investment portfolio going forward. We do see this, we believe this trend is going to continue. And a lot of the factors behind the investment and the priorities that investors had were on first and foremost capital growth or high growth investments. So that would be those growth companies, accessing those growth companies. Two would be recurring income, so those would be yield type plays, and then three would be safety or low risk factors. So those are obviously three different types of investments there that they're looking at.
Thanks, Harry. Lee, I'm going to go to you to talk a little bit. I know that what Rialto does is not crypto. We're very highly regulated. But can you talk about the crypto markets? It seems to be a long few months, and I get the feeling, for better or worse, there's a lot more to come.
How much time do we have, Rob?
30
I
seconds.
need a whole other series. I think what we're seeing is the fact that these crypto markets are unregulated, right? There is nobody in charge of them. A lot of them sit offshore. You're putting your faith in the SBFs of the world to do the right thing, and that without any oversight, and that's a problem. There's just no investor protection. There's nothing that says in investor protection that you make the right investment in the right company. I mean, the companies are going to go up and go down and whatever, and that's okay. That's part of the investing game, but there can't be straight up theft. And that's where investor protection comes from. So in the crypto markets, we've seen a lot of that, unfortunately, whether it's from Celsius, Voyager, Terra, FTX, and I'm sure there's a few more shoes to fall, pretty quickly. What's the answer for crypto? And I think I saw a question out there too in the chat, but what does it mean for crypto in these markets? And I think there is a path forward for these companies in some of the Jobs Act securities that have been laid out there. And I agree with Commissioner Gensler on this, that the rules are already there, right? They provided a framework. Whether or not you want to listen to them or not is a different story. But if you take your NFT, for example, and we're seeing this with what I think is the smart money in looking forward and future proofing, as Sherry had said, taking your NFTs and, if you're going to, sell them to retail, right? You need to know where they are. And the blockchain technology behind it isn't enough, right? There has to be some separation of the money and separation of where the assets are traditionally custodied. And what if you lose your NFT card or your key to access that? You need some recourse. So what we're seeing is that and a lot of the issuers are coming to us saying, how do we do this? And right now our suggestion is, become a serial issuer of a Reg CF or Reg A or Reg D security. So if you have, NFT that is just, I don't know, wild ape, monkey, boat, whatever those things are, which I haven't invested in any of those, by the way. But wrap it in a security form, right? Get a quality securities attorney, right? Understand how those things are constructed, get it through the SEC process, get the housekeeping good stamp of approval, and then, start issuing those properly, through the whole, and performing your AML and KYC, and making sure that you have a cap table manager in the form of a transfer agent or a custodian, working with a broker dealer that's focused on these, what I would call private entities. And then I'll move it into the secondary market. There's only a handful of ATSs that actually have the qualification to trade digitally native assets. We're fortunate to be one of those. Now you have an ecosystem that has investor protections around it, and you've played by the rules. You're still participating in digital, in the tokenized, form, but it also has a regulatory construct around it that will provide you some assurances that that there aren't charlatans swimming with you in that space. So we see a bright future in that.
And if I can just chime in, I know someone in the chat said NFTs aren't securities, they're collectibles. And I know when we say NFT, that means a lot of things. There are lots of different NFTs. However, we believe, and I believe the regulators believe, that there is a stripe of NFTs that are classified as securities. And so we believe sometime in 2023, there will be a resolution around that.
Yeah, I mean, we were actually, there was a news article that came out very recently about the Israeli Securities Authority, and they've made a proposal just, I think, in the last 4 or 5 days, that all cryptos are securities in their mind. And it's going, I think it goes out officially in February 12th, I want to say. And then there's a 6-month holding period. And then, by the end of this year, they would qualify everything crypto, including NFTs, to be a security. Now, that's not the United States. That's not Europe, right? I mean, it's Israel, but it's a bellwether, right, about where regulators are thinking. And I think it's also good to notice that, or think about that, global regulators, like the SEC, like the FSA, like a lot of other entities out there are taking notice. They're trying to see what these folks are doing and forming their own opinions. But there's a trend. There's a trend that's evolving here. And we've heard Gary Gensler come out on this a couple of times too, saying that he believes that most of them are securities in the cryptoverse. And and there's also some interesting commentary about proof of stake blockchains at the layer 1 that could be qualified as securities because of the dividends that can be paid off those. So just it's future-proof yourself if you're in crypto. Like, it's just and I think we could help a lot with that.
It's an important word, future-proof. There is a roadmap to become a security, to register as a security. You can choose to do it, or you can choose not to do it. But it does exist. Lee, I'm going to stay with you and get your thoughts. We're kind of running out of time here quickly. And what are your expectations for private securities? More, less the crypto corner, but more private securities for the year ahead.
I think in 2023 and beyond, we'll see improved adoption of or acceptance and awareness of private securities in both the retail and institutional realm. And I really think it gets down to getting the word out that people now have access to these things. I mean, it was only since 2012 that private securities were accessible to non-accredited investors. And even if you were accredited, that was very slim to none that you were going to get an early taste at Uber or Facebook or something, in the private realm. You had to be an institution or, some sort of, a high-flying private equity firm. So I think it boils down to just getting the word out. And I think that's happening much more rapidly based upon all the statistics we've seen. And again, the ecosystem of private securities. The other thing is I think the sophisticated technology to access these assets is here, and we're ready, right? We've got all the different clarity that we need, to move forward. And it's going to be, underneath the hood, it might look a little bit different. The workflows are different than what trading IBM or Microsoft or something like that. But the experience will be very similar, right? You're going to have to log into a platform, share your information. AML KYC is going to have to run just as if you were going to any one of the major asset managers or big banks that allow you to trade securities. And then you're going to have access to a secondary trading market. It's not going to be centralized in two, extremely major, centrally listed order books. It's going to be diversified or distributed out there, but you're going to have, more and more opportunity as time goes on to buy more of those positions or exit that position at some frequency, whether it's a central limit order book or some point in time cross where, the issuer says, okay, once a month, once a quarter, whatever, we're going to allow some trading to occur here. And I think, finally, just understanding that trading privates is a real option. And, we're poised to take off. We haven't seen a lot of trading in the, as an industry in the privates, but again, I think it's due to, the fact that, more and more people are just becoming aware. There are certain holding periods for some of these securities. And once those mature, we're off to the races.
I agree. We've got a lot of questions coming in from the chat. We have a great audience today, but before we go to Q&A, I'd like to go back to Joel and Sherry and get their final comments specifically on the regulatory expectations for 2023. I think we've answered a lot of the questions that have come in. I'll try to get to them all, but some of them are specifically about regulations in the crypto corner, so to speak.
Sure, I can start and then I'll hand it over to Joel. So, I would echo really what Lee has said. And, the other thing in terms of the regulatory framework, it's really been focused on the digital asset space over the last 6 months. You can't open up a newspaper without reading about it. And over the last few months, we've really seen the SEC and other regulatory bodies such as the NYDFS become a lot more active in their enforcement. Really ensuring that any firm that's operating within a securities framework is implementing the type of robust infrastructure that's outlined in the regulations. And I know it can be frustrating looking in from the outside because it seems like years go by before an enforcement action happens, but these regulatory bodies really need to build a case and to have a case, and there's a lot of evidence that's needed, so it takes time. But I do think that it's clear, Chairman Gensler has said, from November, December of last year through this year, that the rules are clear, what's needed to operate is clear. And so I really anticipate we're going to see a lot more activity as we launch into 2023. And the projects that are starting to flourish and the calls that we're getting really are around those are people that want to, again, future-proof themselves under an established framework. So they're looking and they're saying, I know I want to use this new technology. I know I want to avail myself of these new tools, but I want to do so in a way that I can make sure that I'm doing so in an established framework and in a framework that I'm not going to have to go back and unwind anything. So that's really what I believe is going to start accelerating over 2023.
I'm going to approach it from a slightly different angle and just look at it from the coming at it. It'll end up probably in the same place, but it'll come at it from really the business side. I think in 2023, we're going to see further acceleration of different assets becoming available to investment. We see it now, whether, as we spoke about, music, cars, horses, just anything really can become an asset. The infrastructure exists both from a regulatory framework as well as a technological framework to enable all of those assets, all kinds of things, to become investable and tradable assets. And we're going to see an acceleration. I think we'll see an acceleration of that. And it'll happen and therefore coincide with the regulatory market in one of two ways. Either the market is just going to start really putting out these assets in different ways that the regulators are going to have to find a way to oversee effectively, or the regulators are going to give effective guidance that will enable people to know exactly how to operate within various new assets. Either way, whichever comes first, the chicken or the egg, it's going to result in, I think, a different 2023 ending of the type of assets we look at to invest and the regulatory environment under which they operate. Both of those are going to have movement, either pushing each other or independently and then overlapping in 2023.
Thanks, Joel. I'm going to get to the questions. I don't know if we'll get to all of them, but like I said, we will try to get to you individually. Joel, I'm going to start with you with I think a pretty fast one. George asked, please explain and clarify how 98% of value was created before going public and why.
Sure. So firstly, those were examples, right? We're not, these are successful companies, extremely successful companies in both the private and the public sector at that time. If you just look at the numbers, I believe the numbers are, if you're investing at series at seed round, in a successful investment, and not all are successful, the risk is higher in the seed round. But if someone's investing in that seed round on a successful investment like that, very often it would be a 20-to-1 return. When you're doing it in Series C or D or sort of the IPO stage, it's a little more than one to one, about a 1.25 to 1. And that math basically is going to turn it into somewhere over 90%. In those cases, it was 98. In others, it's 90, and sometimes it's 50. And remember, there's obviously significantly more risk at the earlier stages of investment. Both the issuer and investor have to realize that. But those numbers tend to show that kind of breakdown of about 20-to-1 in seed and about 1.2, 1.3 to 1 in Series C or higher.
But I do think the examples that you spoke about, we're talking about Amazon specifically and Google specifically, and
yeah, we were just giving examples on two before 2000, and two after 2010. Those are just examples of the marketplace and what happened. Just really to tell you, it's not that the private securities, everyone should put all their money in private securities. That's not what we're saying. What we're saying is that the private securities generate significant value creation, and therefore opening that up to investors for potential investment is an addition to an investment portfolio that any investor should consider, or should be allowed to consider, we should say.
Right. Lee, I'm going to read two questions here. One is from Peter. They're very similar. Do you think the SEC will regulate crypto and NFT type companies and determine they are all securities like library? And Chris says, what are the regulatory benefits for a crypto company to use an alternative trading system? Would this improve oversight and stop what we have seen with the likes of FTX? And I'm happy to repeat either one of those questions.
First part, yes. Second part, yes. I do think that the SEC will start working on those companies very closely and quickly recognize, like Library was a good observation by the person who asked the question. Those are securities and those are examples. And this is how the SEC works, right? They go around and, they might not be the flashiest, ways to put it out there, but you have to read the tea leaves of the direction that they're going. They've qualified that as a security, and unfortunately, Library, it has dealt with the consequences of that, and there will be many, many more if they don't get in line. I do think that once these companies realize that there is an avenue, and they're not as I don't know how to say this nicely, but it's not a technology first solution all the time, right? It's you have to play in the regulatory framework. You're selling, products to retail. You're checking every box on the how we test, right? And if you're in the U.S., you're selling it to U.S. citizens. That's a problem in their eyes. Their whole job is to protect, investors in these regulated assets. And unfortunately, many folks have gotten harmed, especially in the retail arm. If they convert it into a Jobs Act security, Reg A, CF, a D, they could protect themselves and their clients / investors with these assets very quickly. I think within a year or sooner, depending on which qualification they wanted to go for. So yeah, I think that there's solutions for them, and yes, the SEC is coming.
Yeah.
And I could just pop in about the ATS question.
Sure.
So should the securities go onto an ATS? Joel and I worked for many years at many different ATSs on Wall Street, and so there are rules around building and operating an alternative trading system, and then there's a rule book around how it can operate and what you can do, and the SEC and FINRA, the regulatory body, are both oversee that, as well as there are certain things like wash trading, like spoofing, that are monitored. So
reporting your trades.
So there's reporting your trades. Reporting your trades. So so that from an actual trading perspective has a much higher degree of oversight. So let me take it from a value chain perspective or a workflow perspective. Coming onto the ATS, everyone goes through anti-money laundering, know your customer, everyone that is on the actual platform. Engaging with the platform, there's a rule set around that engagement. And how individuals and parties can engage with that, and that is monitored by the regulators. And then post those transactions, there is a custodial element around both the cash as well as the securities. So there is no commingling of funds. There's no commingling of securities. There just is no way, not a possibility to have things commingled in the same way.
Yeah,
Yep.
Those are great points, and having regulations isn't always a bad thing.
Yeah, and from the ATS world, just quickly, the ATS world. So, Shari and I met at Instinet, one of the leading ATSs. Shari went on to Goldman and Deutsche Bank to help them build theirs. I was at Citi and Citadel and Liquidnet to help build theirs. Those are a lot of public securities ATSs, and making sure that you're available with the nuances of the private securities markets is a challenge, but somehow bridging that and making sure that the world of ATS, its needs and requirements from both a regulatory perspective as well as a customer interface perspective is essential to make sure it will be successful.
Good point. Thank you, Joel. Well, we didn't come close to getting to every question. We'll try to answer everyone else's questions directly in the coming days. Don't forget, if you arrived a little bit late or missed the ending, the webinar will be available on our YouTube channel, on our website, rialtomarkets.com. We'll also send you the webinar replay, so you'll be getting that in the email shortly. But I do want to thank the audience. They were really engaging. I wish we had more time, and of course thank the panel for their invaluable insights. If you have further questions or simply want to get in touch with us, you can visit rialtomarkets.com, the website. Thanks again, and I hope everybody has a great 2023. Thank you, everybody.
Bye.
Thank you.
Thanks so much.
Thanks for joining.